Welcome back. You're watching KTN Business Today with me, Abi Agina. And we're still keeping it matters ticket. And just what are the perspectives that African countries need to get right when doing business on the global stage? Why so far haven't African citizens reaped the benefits of these businesses? Well, according to Ghanaian President John Mahama, it could be down to how negotiations are carried out when cutting business deals, an aspect which increasingly has to be taken more seriously if we are to derive proper value from business ventures. He spoke to KTN's special correspondent, Alex Chimwada.
Thank you, Your Excellency, for this interview. The first question is, why does this...
But as I said, what Africa needs is trade and investment, not aid. And so we must translate more of this ODA into investments in Africa in respect of attracting the Japanese private sector to either set up wholly in Africa or joint venture with their African partners. And I believe that this sentiment was well received in the gathering.
Now, during the conference, so many deals were signed. For you, what is the most important outcome of the conference, and specifically for Ghana?
Yeah, there are several areas that we're focused on, especially with regards to building resilient public health systems. During the last Ebola outbreak, Japan was a strong member of the international response that helped in rolling back Ebola. And as part of the discussions we've been having, Japan is interested in partnering with Africa to see how we can strengthen the public health systems. Already in Ghana, we're working with Japan on the Noguchi Memorial Center, which is the leading medical research center in West Africa. And we signed an agreement to upgrade it into an advanced medical research center, more like something like a center for disease control. Aside from that, we're working with Japan to put in small remote rural areas, community health improvement compounds. These are small compounds that are manned by a health worker, and they are able to provide, treatment for small ailments, and also, more importantly, able to make referrals, timely referrals, in the event of any public health outbreak or in the event of a complicated birth. They're able to move the mother quickly to a bigger health facility where she is able to deliver safely or have surgery, cesarean section, to take out the child. And so as a result of that, we're seeing a steady decline in maternal commodities. But I think that this new move into Africa is more in respect of investing because of the growing market opportunities, especially if you look at the fact that Africa has the fastest growing middle class in the world currently. Then it means that disposable incomes are increasing, and it becomes beneficial for businesses to come and set up in Africa. And that's why we're seeing what is happening. But I guess that...
So exactly what should African countries do in order to benefit from these offers without...
And if countries in Africa must be able to negotiate properly, then we must be able to match them in terms of knowledge, in terms of negotiation skills. And it doesn't matter if we bring those skills from elsewhere if we don't have it.
Well, and that has been our special coverage of the Ticket 6 conference that ended on Sunday, and we continue to sort of break it down for you to try and get a better understanding of what this conference was all about, despite you having been caught up in traffic or not being able to walk through the city center comfortably. So some billions of dollars came through. It was not in vain. Well, away from ticket, let's now move to another subject that is dominating headlines, and that is of interest rates. Despite two major banks coming out proactively to clarify the situation regarding interest rates on loans to their clients, confusion still reigns days after the president signed the interest rate capping law. With debate raging on whether the KBRR or the CBR is the applicable reference rate and whether the law applies to existing loans, the new law, it seems, has created more heat than light.
Cooperative Bank and the Kenya Commercial Bank are the first two financial institutions to come out to clarify that they will follow the letter of the law and are complying by adjusting their lending rates downwards to 14.5% following the ratification of the law. Cooperative Bank, in a statement to customers and to newsrooms, said in part, "In the foregoing and for business continuity, we advise that pending receipt of full guidelines from the Central Bank of Kenya, all new credit facilities will be applicable at base rate not exceeding 14.5% per annum." KCB, on the other hand, states in a text to customers, and I quote, "In reference to the Banking Amendment Act, all new loans are capped at 14.5% effective today. Guidance on existing loans awaits direction from CBK." End of quote. In all, the move to communicate thus with customers should be laudable. But wait, the lacuna over whether the applicable reference rate in the law is the KBRR at 8.9% or the CBR at 10.5%, meaning that both KCB and Cooperative Bank could still be overcharging clients by up to 1.6%. According to experts, the new law as is refers to the Kenya Bankers reference rate, meaning that both Coop Bank and KCB could be in breach of the law already just days after it was created. While the debate continues to muddy the waters, banking regulator Central Bank has so opted to stay tight-lipped and is yet to take an official position on the operationalization of the law. Then there's the debate on whether the law applies to pre-existing loans. According to Wilfred Onono of the Interest Rate Advisory Center, every borrower now has a right to ask for a recalculation of their existing loan, exposing the banking sector to a truly horrific legal and actuarial scenario.
Basically, what the law is saying is that instead of leaving the banks free to determine the premium they put on the base rate,
yes,
the Act has now said that premium on base rate is a maximum of 4%.
KBA, however, has its own stand on that matter.
Operationalization has not been effected. So far, the existing loans will continue to exist in the books on the basis of the existing terms and conditions until the new law comes into place. Now, if that new law will require the existing loans to be repriced, so be it. If it will only apply to new loans going forward, so be it. But whichever way it comes out, banks will have to comply.
Although the passing of the bill was widely acclaimed by both politicians and the general public, who hold that the new law will accelerate credit growth in the country, it remains to be seen whether the ultimate legal outcome will be in tandem with the spirit of the new law. Abi Agina, KTN Business.
Well, we want to further go deep and understand what this interest rates debate is all about. And we are now joined live from our City Center studios with Johnson Nderi, who is an analyst and works at ABC Capital, just to give us more perspectives into this hot topic. Good afternoon, Nderi. Good to see you. Interesting developments around capping of interest rates. Of course, many didn't expect the president to assent to the bill. But from where you sit, how should this law be applied? Because there is that confusion around, will these new interest rates affect the old loans or not?
well, ideally, I don't think they ought to, and the reason is simple. Historically, in order to get into contract with borrowers, you have to get into contract with lenders, because you've got to match borrowing and lending in terms of duration and in terms of interest rates. taking into account your costs of operations. And so the idea of that matching is what, some of this funding has already been fixed. Some of it is fixed through fixed deposit accounts, some of it is fixed through bonds, and therefore I think the current contracts should be allowed, could really affect the way businesses as they are right now.
All right. But Nderi, we've seen other pundits saying that it should apply actually, because the general sense of the majority of Kenyans is the fact that today if fuel prices were revised downwards, you'd see the petrol stations taking time to adjust the prices. But when they are increased, you see immediately they also adjust the prices. Help us understand, why doesn't the banking sector also work in this format, and what sort of actions need to be taken? Do we need to see a court sort of ruling that compels banks to also say apply the loans at the new rate?
Well, I think the loans being applied for now are being applied on the basis of the new rates. And even then, there's still confusion as to what the base rate is with regards to the lending. But with regards to the older loans...
Before I let you go, Nderi, so if today we are seeing, actually yesterday we saw KCB and Cooperative Bank announce that all new loans will be disbursed at 14.5%. What do you make of this news? As well as the same banks, and amongst other banks, they've also suspended the issuance of car loans, and also we've seen emergency loans and also unsecured loans. What would be the reasoning behind this?
Well, some of those things could be operational in the sense that the systems need to be reconfigured, because some of those things have some of those systems have automatic features with regards to changes in rates.
All right.
And other fees. So those need to be reconfigured first.
Mm-hmm.
The other issue obviously will be pricing. Obviously, you don't expect
is to end the conversation. We've actually been speaking to Johnson Nderi, joining us live from our City Center studios to help us make some analysis out of the interest rate dilemma, where we are seeing banks are still trying to find their way on how to maneuver out of this sort of dark path around the interest rates. And from matters to do with the interest rates, we have some good news where a Kenyan has won a food prize. And we are joined now by Peter Wakaba, who joins us by way of phone, just to also give us more info on this prize at what it...
That for a very long time, farmers in the northeastern parts of this country, the really dry areas, have been at the mercy of the weather.
Yeah.
Every time it is dry, the rains fail, there's no pasture, and the livestock doesn't grow. And this usually means losses of lives and losses of livelihoods.
Mm-hmm.
Now, what he did was create a thing called weather-based index insurance for livestock,
mm-hmm.
which enables him, which enables insurance companies through the use of technology be able to project a time when losses in livestock are expected.
Yeah.
And this data is then used in place of physical verification where, for example, if you had a vehicle accident and the insurance would conduct a verification on the spot. But it's impractical to expect insurance people to go to the northeastern parts of this country and across East Africa and the Horn of Africa to be able to physically verify and count how many animals have died.
Mm-hmm.
International Livestock Research Institute here in Nairobi.
Yeah.
That's, of course, Jimmy Smith. And he says that Moody's selection as the winner of the 2016 Field Award for individuals under the age of 40 is indeed groundbreaking, because it reflects persistence in his science-based, community-mediated, innovative approach to providing financial protection through insurance to millions of poor herders and their families who care for and depend upon livestock as they move across the vast rangelands that are in East Africa.
Okay.
Indeed, it is a matter of great pride for the country, for Kenya, that the two of the first 5 Field Award recipients are here in Kenya.
All right.
Now, a lady by the name of Dr. Charity Mutegi also received the award in 2013.
All right.
And just before I go, just to tell you that the award, of course, is accompanied by a $10,000 prize up to about 1 million shillings.
Yeah.
With the award itself being awarded by the Rockefeller Foundation.
Yes.
The president
Winner.
Yeah, I said, just like I said a few minutes ago, $10,000, that's
All right.
about 1 million shillings. This is, of course, a personal endowment.
Okay.
The fact that being able to produce in weather-based index insurance is a partnership of so many different organizations, from the guys who create
Fantastic.
the data using weather programs, the guys who come up with
Yeah.
the insurance programs themselves, means that this is a thing that is sure to attract worldwide attention.
Okay.
You can be sure that lots of global insurance companies will start to sort of look at this industry in a very big way.
Okay.
And just to give you a sense.
And before we leave you, we just want to do a quick recap of our Twitter poll question for today. As you know, this week we'll be focusing on the TCAD conference that ended on Sunday. And we were asking you the simple question around, out of the MOUs that were signed at the TCAD 6 Summit, what will be of most interest to you, and do you feel the local businesses will benefit? We are asking you, out of the